Hello, I'm Sam Stovall, Chief Equity Strategist of S&P Capital IQ. At this week's Investment Policy Committee meeting, we discussed the importance of yields within one's portfolio, as well as the need to be selective. There's an old saying that the best defense is a good offense. Since the mid-November low, however, stock investors have turned this adage on its ear, concluding that the best offense was being in the defensive sectors. Year-to-date through April 15th, the four traditional defensive sectors in the S&P 500, meaning consumer staples, healthcare, telecom services, and utilities, gained an average 18% versus the S&P 500's 14% and the cyclical sector's 12%. Indeed, investors have been gravitating to the defensive side of the spectrum for as long as the Fed has been denying them the ability to live off of the income supplied by record low bond yields. As a result, the defensive sector results have outperformed the cyclical groups. Yet as overindulgence tends to affect one's waistline, so too have the valuations of defensive groups widened along with the spread between their current price and rolling 40-week moving average. Even though overpriced investments usually regress to their mean over time, we still believe there are reasons to own higher yielding equities. One reason is that besides offering a cushion during market declines, a high yield for the S&P 500 relative to the yield on the 10-year Treasury bond has been a fairly reliable indicator of favorable 12-month forward equity price returns. Since 1953, when the yield on the S&P 500 exceeded that of the 10-year bond, the S&P 500 rose an average 19% in price in the following 12 months. Remember, of course, that past performance is no guarantee of future results. In this week's Sector Watch report, I suggest that investors be a bit more selective, and I identify several stocks and ETFs that warrant attention using MarketScope Advisor's screening capability. I'm Sam Stovall, and I'll talk with you again next week.